Welcome back, everyone, to the Kingscrowd Podcast. My name's Brian Belley, Vice President of Product, your host here each week. Each week, we break down the biggest moves in startup investing, and we look at retail investing deal flow, to platform trends, to regulation updates, and everything in between. If it's moving the market or having an impact on raising capital or investing online, we are going to cover it here. This week, we have two topics we're going to be talking about. In the first segment, I'm going to welcome back Scott, where we are going to talk about a show and a guest that he's recently had on his pod, The Scott Show, in terms of just what is changing around VC when we take a look over the past couple of years. Then in the second segment, we have the hot off the presses April 2025 regulation crowdfunding report. We'll take a look at some of the top fundraisers for the month and how the markets in general are doing and what that means for investors. All right, for the first segment, welcome back, Scott Kitun, Industry Insider. Now, Scott is a prior host of a very popular show, media show, Technori. He had lots of awesome guests, and he's recently been relaunching that with The Scott Show. So The Scott Show is his new pod. Make sure you check it out. I'll give you a shout out, Scott. I've been listening to some of the episodes. Listened to one of them a couple weeks ago on, sports betting, and I don't know if you had anything riding on the Kentucky Derby this past weekend, but I'm sure that was interesting.
I didn't this time. Yeah, that was fun. Thank you for that, by the way. The concept of that show relative to Technori is it's tech, money, and media. It's kind of this like whole intersection we all live in now, where we did a show the other day with the guy who wrote the takedown piece for Jay Shetty, and it was about grifting. We all, in particular in investing, we're talking about this all the time, about people coming on and talking heads and trying to sell you this and that. And the idea of this show going forward is to just, one, to keep it interesting for myself and just keep talking to cool people. But I also want audience members, many of which are Technori and many of which are Kingscrowd users, to just like kind of be able to learn and see and meet new people who live in the space that you probably wouldn't otherwise, interact with. So that's that. And this show that we did this last week was someone who I think a lot of people in this audience should know. Sam Lessin, his wife, Jessica, is the founder of The Information. He was an early product, probably a roommate of Zuckerberg's at Harvard. I didn't confirm that, but they were in school at the same time. He was an early product guy at Facebook, had obviously success with that company. It's grown somewhat decently over the years. It's a shitty joke. At any rate, he started Slow Ventures. Now he started a creator fund. In 2023, he wrote this like State of the Union for VC. And it's the first time that I ever heard the term venture factory. I don't know if he coined it, but it's the first time I heard it. And it resonated with me immediately because I was going through raising capital for Songfinch, and we were like literally hitting the venture factory, and like we hit it head on. And now in retrospect, it's like, God, if only I had read that 6 months prior, we'd maybe have different scenarios. But he called 23 to 25 almost perfectly. And now he's out with I'll warn everyone, it's a 108-page deck. It does have some rhetorical from 23, but still, it's a long deck. So you just go to @Lessin on Twitter, and he's got it pinned to his thing, and you can read it. And you should if you're investing or in startups or venture. But he wrote the 25 State of the Union, or VC 25, whatever he called it, and it's basically like, look, the venture factory is dead. No one will say it better than him. So why don't we play a quick clip of Sam talking about what venture factory is and kind of what happened.
But if you think about it, what venture was, call it from 2010 to 2020 roughly, was a factory line, right? And the product it produced at the back end is public companies, right? Like it was a public company machine.
In theory.
Right? Yeah. In theory. And that actually did kind of work for a while, but the public market was like, we demand tech startups, that we'd like them to be a few $1 billion that they can grow, and like we want to be able to invest. And like then you think about what happened is, well, what happened? Well, the late stage investors figured out their job was to serve the public market, so they had to put capital in to like finish the product to serve the public market. Well, the early stage investors started working on pieces to like hand to the late stage. You basically ended up with this like conveyor belt factory line. We're seed investors. We did the very beginning. We kind of take the raw components, and we stopped actually, I think as a class, seed investors in that era, stop being focused on what's a really, really high quality, long-term important business, and started to get into the game because it's kind of what the system demanded of us of how do we find the entrepreneur and the idea, put the money in, package it properly, and send it to the Series A people with $1 million in ARR, so they would then take it and do their stage of production all the way through. Now, what happened in the pandemic and kind of the aftermath of it was the factory line broke, right? Because and the reason was an interesting one, which is the public market kind of stopped demanding these like middling private to public tech companies. And there's a bunch of reasons for that, including the fact that the upper bound on how big tech companies could got released. So you said, we should just buy more Meta. There was an era where like $100 billion company was unfathomable. Once you cross like $1 trillion companies and you're a big asset manager or you're just like, well, I'll just give more money. And there's a whole asterisk around meme stocks and blah, but like in general, all the capital is like, we'll just put it more in Apple, right? So then there's no
the
point.
Reason 30% of the money is in 7 companies. I mean,
right. It's also partially because of the market structure where like you just don't really have, effectively these hedge funds anymore that are running around with like a human operator reading documents and trying to figure out what's a good company. And like that's partially because the private guys in the late stage got greedy and marked everything up and held on to the good companies, and Chamath put out the shitty companies. And so it was like, well, fuck you. You burned me on the shitty companies. I don't like your machine anymore, right? And so there's this whole meta game that played out, but the net of it all is the factory broke. You ended up with a bunch of these unicorns that are have become what I call now zombie corns, right? They're like dead on the factory line. They're technically super highly valued. A lot of people thought they were going to completely die. They didn't. Like they kind of cut burn. They figure out how to stay alive. They're kind of there, but they're not growing. And they're kind of, no one knows what they're worth. They're just kind of soaking up talent and air effectively, right? And it kind of ripples through the whole system. And all of a sudden, these standardized metrics of you hit these numbers, you get a Series A, right? Just like go away, right? Which kind of changes it. And so the new model, which I talk about, which I see playing out now, which replaced this. The 2023 was factory off. 2025 is factory broken. Factory is not coming back, right? And what's replacing it is what I'm calling the Regatta Model, right? Where in some ways, you have companies that exist in a certain ecosystem. They can exist at seed, right? They can exist as kind of a early round lettered company. They can exist but they're actually in some ways distinct ecosystems, and they're all kind of jockeying and raising capital on demand. There aren't standard metrics, right? They're just trying to find something that matters, right? Something that can grow. And then once they do, every once in a while, one can kind of graduate or skip markets to the next market. But they're much more like circular as opposed to like a linear factory line in terms of how companies develop, right? So you'll see a company raise 4 rounds of seed investing. Fine, if that's what it takes. What's the price? Well, the price is what someone's going to pay.
Yeah. So, I mean, as he clearly identifies, like the venture factory's biggest problem ultimately is that people kind of got lazy and they reverse engineered success, and you've got no IPOs, and there's just too much opportunity in private capital between credit and private equity to stay private longer. There's not an incentive to have a $100 billion company be valued by the public at 40 or 50 billion, when privately you have all the benefits of lending against your $100 billion valued company. And so that change, that shift created a massive problem where it just leaves a dearth of like what he called zombie corns, which are companies that are effectively worth no value, but sitting on a hoard of cash and have figured out how to stay operational. And if you just go from there, like it just work its way backwards to the original pre-seed, it screws everything up, right? I mean, the managing director or whoever, investor, principal, associate at name your seed fund, their entire job is to find a handful of deals that elevate, and then they get promoted to partner, and then they go to a growth stage fund, and they kind of move up the ranks. The entire system has been, it worked for 10 or 12 years because you were living off the laurels of Meta and Coinbase and Airbnb and now seemingly Reddit, although that took a lot longer, of companies that did the IPO chase and it worked out for them. When these companies went public, they had a lot more value left to be extracted. Companies today like Stripe and Plaid and some of these, they're staying private because they'll only go backwards, or they will go backwards for quite a while and then they'll go forward, but it's going to take a while and no one wants to ride it out. And, they also would owe their employees money. It's just a whole lot of stuff. So the gazillion MBAs who dove feet, face, nose, ass first into venture, having zero operational skills or knowledge or experience, were like, oh, I'm smart. I'm a math guy. I'll just reverse engineer how we play a volume game, and we shuffle and hand off the price at a discount to the next player for A, B, C, D, IPO, check, we win. Well, IPO clogged, no IPOs. IPOs that do go through go backwards, and you have a problem. And so now, as a result, you've got, I don't know the exact figure, but it's in the trillions of money either sitting in LPs with promises to invest, but not really wanting to, and dry powder where it's like, well, we need to find a whole new batch of companies to invest in, because to continue to invest our dry powder in the companies that we currently have stakes in that are sitting at the series C and D, they're zombie corns. So obviously we're not going to do that. So that is the crux of the problem. The solution, I think, is playing itself out in real time.
So I'm curious, Scott, in your own investing, given that someone who invests his own capital, who participates in funds, are you changing the way that you think of looking at deals compared to, say, 2010, Scott, if you were assessing an opportunity, right? There was certain changes going on with the shift to mobile and social. Yeah. Now we're obviously seeing a lot more shifts in different areas, but I'm curious how you're looking at opportunities today, where the 2010s, maybe everything was SaaS, right? Everyone wanted to be a software as a service investor, great margins, fast growth, like capital efficient. What's that look like today? What are you looking at?
If I could grab 2013 Scott by the back of the neck, I would have told him the venture thing is really cool and you should definitely dabble and don't say no to cool things that you like, but put the bulk of your money in private equity or somewhere that has just consistency. And, it sounds like hindsight and sour grapes. It's not. It's just the more time you spend in this, the more you read Warren Buffett type stuff, the more you're like, God damn, this dude was right the whole time. And we're chasing Cathie Wood when Warren Buffett's right in front of you. And Charlie Munger, before he passed away, I think said it perfectly. Get used to doing more with less, having less. And that it sounded depressing at the time, but I think it's proving itself to be true 2 or 3 years later. And what I mean by that is that when I first got into the space in 2010, 11, 12, and I'm looking at the mobile app world, the beacons, for all those who remember beacons and the original QR code, boom. That stuff was transformational in a way that was predictable. And you could see why a legacy media company would buy app companies, because they were basically renting digital R&D, and the prices are going to be overpaid because they are flush with cash and stupid. And then the next 5 years go by and the legacy media companies basically, and when I say legacy media, I'm not talking about New York Times. I'm talking about Comcast, AT&T. They start Yahoo. They start going backwards. So now they don't have money, and tech companies start uprooting them. And then you get SaaS is the new play, and SaaS is going to eat the world. And really that was a predictor for what AI will do. Mm-hmm. The difference is that SaaS, it's like a black box. You either own Salesforce and you operate a end-to-end marketing system, or you don't. If you don't, you don't have scale. And if you do, you have scale, but you pay for it. In that universe, it was pretty easy to identify what companies I should invest in just based on smart founder technology that I could use, and I could definitely see who buys them. And there's not just one, but there's 10 who could probably buy them. Now we're in a place with AI where there is no such thing as moat. There is no such thing as differentiation. There is no such thing as something that will work for a long time. It just evolves day to day to day. Scaling companies requires agents and 5 people, not 500. There's no predictable outcome other than access to capital and somebody who's just smart as shit. I don't think you're going to get, this is the Charlie Munger, I don't think you're going to get the returns from that no matter what you do that you would have gotten in the SaaS era, and most certainly in the mobile app, initial internet era, post.com bubble era. So going forward, if you're in venture, I think that you're going to be deploying a lot of capital into, back to this bits and atoms kind of space, the atoms that help, or I should say the bits that help move the atoms. And for those listening who don't know what I'm talking about, Brian is a rocket scientist, so I know that he knows what I'm talking about. But for those who are listening, it's the technology and the artificial intelligence and the agents and the compute and all these things that enable us to live in basically an autonomous, robotic, automated, drone-heavy, defense-heavy, go to Mars world. Big business isn't going to really change. The banks are always going to be acquirers. They're not going to be people who are R&D, investment, innovation heavy will stay that way, and people who are now will always buy their way out. So I don't think it's going to change a lot there, but the money and the risk moves downstream. And I think what you're seeing is a lot of venture firms. Lightspeed just announced this week. Last week or 2 weeks ago, it was GC talking about this. They're turning into PE firms, they're turning into buying businesses, hiring CEOs, not MP, MD, whatever, GP. They're literally trying to get into the private equitification world. And I think it's smart. And I think it all originates from Sam's document. He talks about a bunch of it, but it really is the move is like making big bets over here will take a lot of money. So what we own now, we've got to figure out a way to monetize and maximize. And so I just think the next generation of venture, it's really funny. I'll wrap and say I talk way too long. The beginning of venture capital, it was a part of private equity. Venture is a part of private equity. People don't remember that. For 14 years, you would never say that. Venture wouldn't say that. They'd say, we're not private equity, we're venture capital. And people would leave PE and go into venture, be like, I'm in venture, not PE. And now, fast forward 14 years, a couple of bad deals later, a little bit of loose finance later, and ventures, no. We're just like one of the parts of private equity. We've always been private equity, which is fucking hilarious to see. But I do think it's where it's going.
Interesting. Yeah, I think a few things you touched on just definitely resonate with my experience as well as an investor. I mean, if there's one thing you learn after you've been investing through kind of more than one cycle or, on the order of decades, it's that to continue to outperform and find alpha or do well, what worked back then is not going to work today. Like you can't keep doing the same thing. And people are always forward thinking. You have to be thinking, okay, what is that next thing going to be? Because one of the things you often see, and I kind of use this analogy as well, but like the pendulum swings really far in one direction, investors rush into whatever that thing is, whether it's technology or trend or, thesis. But by the very nature of everyone rushing into it, that thing becomes overpriced to the point where you can't make a good return anymore. So
yeah, Brian, I totally agree with you. And I think the funny thing, this is the only part that's different than the conversations you and I probably would have had over the last decade, is in the past, the bad behavior or whatever could be learned from, and you'd be like, oh, you're to your point, the pendulum. This is different this time because the mobile internet buzz change was like a monumental shift that required physical hardware. Yep. So you knew where it was made, what it would cost. We have it now with energy and compute, but that's being worked on daily. The output of AI is so massive and unpredictable that I don't think if I'm an emerging fund manager right now, I'm just not an emerging fund manager right now. Like that's kind of what I would say. Like I think on early companies, if you're like, we're going to give you enough cash to build something and sustain it, and then we're not going to raise money, we're just going to become a profitable business, and that's whatever. That's called PE, by the way. But like that's what they're doing, because I think the tech is making it really difficult to scale a company that's defensible. Mm-hmm. And that's not exclusive. I don't mean that generally for everybody. That's not true. But like largely where you and I could hear 20 pitches for some random SaaS for X, Y, Z, and D. Now it's like AI agent 1, but actually could be used for this and this, and then actually that. And then like actually during my pitch, somebody else actually just created a new one. And now like it's so insane that I just think that as we've said for years, time and data move faster and faster and faster. And now we've just hit this next evolution of speed that is unfortunately faster than the human mind. And that makes it really difficult. SaaS, you could, you're hearing this thing play out now with Rippling and Deal. Like you could have a plant who works at Rippling to try to rip off how they run their SaaS model and go back and repeat it over years. I don't need to have a person sit in at Rippling to figure it out. I literally can go build it on Replit and ChatGPT in about a week. I have a business.
Awesome. And then again, reminder, shout out to Scott here. Make sure everyone checks out the Scott Show. Great pod.
ScottShow.com. Thank you. I appreciate it.
Awesome. Well, thanks, Scott. We'll wrap up that segment. Let's now bring in Senior Investment Associate Léa to talk about with us the 2025 April funding report for regulation crowdfunding. So as most of you know, Kingscrowd runs all the data. We overlook all of the retail online private markets. And when we took a look at April 2025 investment action, there was about $41 million raised last month. A lot of the same top performers that we've seen in terms of platforms, but I'm going to pull that up so we can take a look at the data and then also talk about some of the top raises and some of the trends that we're seeing. All right, so this is our breakdown. And again, make sure if you aren't already, you get all of these weekly emails. Join our newsletter, free, newsletter.kingscrowd.com. But as you can see, for April, for regulation crowdfunding, a lot of the similar names for top platforms. So Wefunder in here raised about almost $18 million. StartEngine at a little bit under 10 million at around 9.3. There was Republic with 2.2, Dealmaker almost also up there with 4.6, and Net Capital. The deals around the outside, you can see are some of the names. So Plunge, for example, one of the top raises in the month. Avadain, past issuer, also an issuer on Net Capital. And then different ones on WeFunder, such as Arrived, Atoms, and some other. Léa, I'm going to turn it over to you real quick. I know that you've been taking a lot of looks at a lot of these different deals. I know a few of these are also past top deals for Kingscrowd, like Qnetic and some others. What are you seeing in terms of trends for the market?
Well, April is a very special month in equity crowdfunding, as many of you know. A lot of deals close by April to the 30th because after that date, in order to stay open or to open a new raise, they will need to provide 2024 financials. As a result, a lot of companies decide to close by that date or open very short raises. And therefore, for the most successful deal, we know that we can have a lot of momentum being built at the very end, and a lot of money can be raised. So if we take a look at a couple of kind of the deals that perform the best. So at the very top, we have Arrived. What is very interesting with Arrived is that they only started raising on April 8th and closed by May 1st, which means that they raised $2.3 million in less than a month. This is very, very impressive. This is a company that provides a platform for investors to invest in fractional rental homes and vacation rental. So it's not the type of industry, I want to say, that is typically overperforming on equity crowdfunding platform. Brian, do you know a little bit more about that company? Do you have an idea about, why they will do so well?
No, so Arrived is actually also a past fundraiser. So they've done some different debt deals for some of the real estate investing. And I think one of the things you could say, right, is that similar to Kingscrowd ourselves, a lot of these platforms that offer new investment opportunities for investors who are investing online, like investors understand that it's something that they want to use themselves, that I think they can see themselves using. And so a part of it, I think, is that relatability to be able to say, hey, this is a platform I use already, or I might like to use. They can kind of see the future potential of that and, perhaps invest for that reason. The other thing, it is pretty mature. There's definitely some significant revenues here. This is not a brand new company. And so oftentimes what we'll see are that some of these more mature companies, especially if they have more substantial assets, some of the cash here and everything else, they can potentially invest more in marketing and or have a bigger audience to be able to engage. So all of those factors of kind of their maturity and just the familiarity, I think, with a lot of the investors in the online markets. I don't have any other kind of specific insight knowledge in terms of this particular company, but those are a few of my quick thoughts.
Yeah, that makes sense. We see companies like StartEngine, Wefunder raising a lot of money for themselves. So it's normal that Arrive would do the same thing.
I noticed also, Léa, and just for clarification of this chart as well, so all these numbers are just the amounts that were actually raised in April. So some of these companies, for example, Avadain, have raised more than that total, but this was just the amounts raised in April of 2025, because we do track that total amount. Now, the other interesting thing that Léa was mentioning is around the closing each year. And you can actually see that from the Kingscrowd Markets page. There's this dip every year from April to May, and it's very apparent. This is showing equity raises for Reg CF. It's very apparent how the drop is significant. It's probably almost a 20%, 25% drop each year. And we'll see the same thing this month where, April kind of peaked at the 457 equity raises. May is probably going to be a drop because those companies need to get those updated financials in place. And that's often a reason for them to close their raise or wait until after that date so they can get those financials prepared, which again, per Reg CF, has to be in GAAP format, has to be either, reviewed or potentially audited, depending on how much they're raising. These are a lot of logistics and sometimes cost to be able to get all that in place, which definitely drives the market in terms of which opportunities are available. So good thing to remember if you're an investor, right? You will probably have more opportunities available leading up to that, but then fewer until it kind of comes back through that lull in the summer again, and then starts picking up again in the fall and the later in the year timeframe.
you just talked about Avadine. I think Avadine is a very interesting company when we try to understand why they're raising so much money. So we know that sometimes companies that are successful, they may already have a big following. They may have built an investor following, not only customer, but over the years. Some of them are spending a lot on marketing and it's giving them a return. For Avadine, what we discovered is that there are actually some very active investor groups on Reddit or other platforms like Discord that sometimes would just pick a deal, invest in it very quickly, and help that deal reach that maximum. And that's kind of what happened with Avadine. So if you're, not part of these tiny groups, it can be a little bit difficult for you sometimes to invest before the close. But that's interesting because it means these investors are saying something very, very interesting in Avadine. And we know that investing in this company is an interesting and very different deal for a equity crowdfunding platform because you're really investing into a material, a new technology that has just so many applications. But it's one of the deals that could be completely overlooked if a horde of investors was not widely investing into it.
That's a really good point. It's something where, as you were mentioning, there's some of these different investor groups out there, but within these retail private markets, a small group of investors can actually drive pretty significant capital flows. So especially where sometimes there's more of this follow the crowd mentality as well. Once you get that flywheel started in terms of, raising a lot of capital, it can really help kind of bring you through to the end of your raise where other people might take a look at it and say, oh, Avadine, I maybe hadn't heard of them, or why are they doing so well this week? Maybe I should take a look at them. So for founders out there who are listening, that's really stressing the importance of one of the things that Léa here has looked at in the past as well from our data, which is it's very crucial, right, to come out of the gate pretty strong, because some of the strangers who wouldn't be able to find you otherwise will be able to discover you if you can get kind of your community engaged, be able to come out with good commitments. And then on the back end as well, those final few weeks are also definitely very important. Now, in terms of just a few of the other raises, Kinetic passed Kingscrowd top deal, also doing well as Rise Robotics, I believe, doing pretty well up there. So there's some other familiar names for sure that people have probably seen around. Any other takeaways, Léa, in terms of either just general trends in the market or deals that you're seeing now with kind of this passing of that financial requirement deadline and into May?
April is always kind of a sad time for me because I have my favorite companies I've been following over a while for what that I see closing, but it's just so exciting because it's a new beginning. And I'm just, excited to find some new winners quickly.
Awesome. Well, again, as a reminder, these reports are something that we put out every week or every month. We also do reviews of these different deals, and you can get all of that for free in our weekly newsletter at newsletter.kingscrowd.com. Make sure you head over there and sign up. I think we'll wrap things up there for today, but thank you, Léa, for your insights and knowledge, and we'll see everyone back here in the next episode.